Hello, beautiful. Oh, today I want to talk about, honestly, something that is my pet project, maybe my passion, and it might be irrational and it might not be what you want to hear about at all. Definitely let me know. Send me a DM on Instagram because I am so passionate about talking about saving for retirement as a person with a modest income and as a, younger generation person, a millennial, a Gen Z person. And yet my feeling is that it's not landing. My feeling is that it's not happening and that people are writing off, especially people in the caring and creative fields, people who tend to be underpaid. I think there's a tendency to write off the idea that retirement is ever going to work for you and to just not look at it, right? And what makes me so sad and so upset about that is that there are tax advantaged accounts that literally make it possible, but what it requires is starting early. That is the key to actually having a gigantic pile of FU money at the end of your career so that you can actually rest, right? And it allows you all sorts of other things. It allows you, like an ace in your back pocket to walk away from bad, toxic situations, toxic relationships, workplaces, things that are bad for you. It gives you power and control in your career. And it also just allows you to say yes to the things you want to in life. So it's really my passion that ethical, good people doing good work, whether you are an artist, a creative person, a healer, someone who is in service of a community you love and care for, I want you to have FU money. So I want to talk about retirement today. I want to talk about the idea of not writing it off. And here I don't mean like a tax write-off. I mean like don't write it off and dismiss it as something that's impossible. I want to show you that it is possible. All right. Okay, so a little a little background. I read the statistic recently that 66% of millennials have not $1, have zero saved for retirement. And that just depresses the ever loving shit out of me. um, and I honestly, I just hosted a free class just yesterday and just kind of coming off the vibes of that. And I thought it was a really wonderful and valuable class. And I know that the people on it got a ton out of it because they told me so. But I came away having the feeling like, I think I'm putting more emphasis on retirement than people want to hear about. Because this isn't why people are coming to me, right? I think that people join my program for tax help paying quarterly taxes and setting up systems to pay taxes, effectively and stay out of tax debt, and to sort out those like thorny legal issues like, do I need an LLC? Do I need an S corp? What does that mean for my taxes? What does that mean for my, liability and my finances? And Money Bootcamp is for that, right? That is fully, in fact, more than half of the programming inside Money Bootcamp is for that. And I think that's why people join. But I have stuff in there about investing and using tax advantaged accounts and year-end tax planning, which are the keys, I call them the power triangle, to really building a pile of FU money. And I feel like these are skills that are underutilized in our world. And when I say our world, I mean you, the listener, the caring person, the person who has a mission, who might be underpaid and have let maybe are not coming from a place of financial education the way that I was when I was younger. So I want to talk about it today. And I realized that I think I spend too much time talking about this, and it may not be what you want to hear about. I think a lot of people in this position write it off. And I'm just here to say it makes me so sad. And I really keep hammering on this thing that I think my own audience doesn't want to hear about because I know it's possible. And I think when you see the math, that you will believe me because the math is there. The math is true. So, and if you want a way to see the math and see me shoot myself in the foot when it comes to actually marketing my program according to the things that people actually want. You can watch, a class that a recording of the class that I give every couple months or so. You can join it at go.sunlighttax.com/register. And just something to know is that in that class, I show you with graphs what the math is when you put the maximum IRA contribution in every single year over the span of a full career, and how little money it takes you to actually become more than a millionaire, to have more than $1 million, to have enough money to generate a full salary without you working at the end of your career, which is literally what establishing retirement accounts are about. The point is to have enough money that you can live off of the interest that comes from that money, that giant pile of FU money. All right, so you can go there, go.sunlighttax.com/register if you want to see that recording and you want to see me go through the chart and the graph of how that math actually works, because I'm pretty passionate about talking about it. I don't think it makes for great podcast content, so I won't bore you here with that. I want to talk about some updates that the IRS has made to the contribution thresholds for these tax-advantaged accounts, because it is time to update your contributions. All right. That's what I want to talk to you about today. All right. So let's go through. I actually have this document from the IRS open in front of me, and I'm just going to kind of read through it a little bit and interpret it, because you might need a little bit of that, the zhuzh. All right, so here goes. For tax year 2023, the IRS has been, or the Biden administration in particular, has been quite serious about getting U.S. taxpayers to put more money into their retirement accounts. And just in case you aren't even aware of the basic level, the U.S. government has created these tax-advantaged accounts where you can put money in tax deferred, right? And when you do that, what it means is the money in those accounts grows faster because it is not subject to the taxation annually that a normal brokerage investment account is subject to. So your money is actually growing faster when you put it into retirement accounts, as opposed to simply through normal brokerage accounts, brokerage investment accounts. All right. That's a really key thing to know. The other thing is that you either get a tax benefit when you put the money in. So in the year you put the money in, if it's a traditional account, that amount that you put in dollar for dollar comes off your taxable income. In other words, it forms a tax shelter for you. Or if you do a Roth version of the account, and there are Roth 401ks and there's Roth IRAs, the Roth version is a tax benefit to you later. So a Roth contribution is really awesome. It will not give you a current year tax benefit. You will report that as your contribution still as taxable income, but when you take the money out at retirement age, the money is tax-free. And that is kind of a genius miracle, because the fact is you are saving taxes on an unknown future tax rate, right? And most accountants and economists agree that tax rates in the US are unsustainably low and that they will go up. Okay, so the chance, we don't know the future, nobody does. If somebody tells you they know the future, they are scamming you. But we think, based on, where things are, we think that tax rates will go up in this country. So you're saving on probably a higher rate than you're paying right now. Okay, so that's the purpose of these retirement accounts. It's not scamming the system to use them. I've actually been accused of being a scammer by random people on the internet yelling at me, thinking that it's somehow bad for people to be using 401ks, 403bs, IRAs. Ask my children, because when I saw that comment, that really mean comment on Instagram, I cried at the dinner table. I do not have the world's thickest skin, and I hate shit like that. But it's not a scam. The government sets up those accounts because it is in the national interest for you to put money into your retirement account. And I say this, as a person who did AmeriCorps and actually did volunteer work in a state-run retirement home, the fact is the US government doesn't want to pay for those. They don't want to pay for them, and you don't really want to be in one. You want the control over where you retire and what kind of retirement you have, what your retirement looks like, right? The US government doesn't want to pay for your retirement, so they give you really juicy tax shelters so you pay for it, right? That's why they do it. They make a tax shelter to incentivize you to do something generally that's in the societal interest. So in this case, retirement. There are tax shelters for other things like health savings and education savings. And in general, as with retirement, the government is creating these tax shelters, tax advantage accounts on purpose so that people save for big ticket items that are difficult to gather the money for. Okay, so it's not a scam, it's a good thing. You are doing a good thing when you put money in here. And the US government would not create these incentives if it didn't want you to use them. It literally creates the incentives to encourage you to use them. So please, we're all on board here. Let's all get on board with this project. It's a good one. All right, so I want to go through just some updates to the threshold contribution amounts because they changed for 2023. Pretty big changes, bigger than usual changes between 2022 and 2023. Okay. So I'm not going to read you this whole IRS document. I mean, my God, that would not make a fun podcast, but I'll read you the kind of key parts. So I want you to know that the IRA, the contribution limit for employees who participate in a 401k, 403b, has increased this year to $22,500. So that's up a full $2,000, almost 10% from last year's $20,500. Okay. And for those of you who are self-employed, which is probably everyone listening, I'm including that piece of information here because you might have a solo 401k, right? I have one. It's something I teach in Money Bootcamp, but a solo 401k is included, right? So in a solo 401k, you can put now up to $22,500. All right. The annual limit to IRA contributions, IRAs are much smaller, FYI, and that's why one of the reasons you should always prioritize a 401k if you have access to it. But the IRA contribution limit increases from $6,000 to $6,500. Again, close to a 10% increase. It's pretty big. The catch-up rate for IRA contributions remains the same. And so it's $1,000 catch-up contribution if you're over age 50. Now, the catch-up contribution for 401ks, 403bs, has actually increased a little bit. And it is now $7,500. So the catch-up contribution in a 401k is even higher than the total contribution for an IRA. All right. There are these income limits called phase-outs, where if your household income is above a certain threshold, then you are no longer allowed to make deductible contributions to a traditional IRA. And then there's a higher dollar amount phase out for contributing to a Roth IRA. So if your income is too high for the traditional IRA phase out, you might want to consider a Roth. And then sometimes your income is just too high for both. And I will say to you, this is pretty interesting, but even when that happens, taxpayers often will choose to still contribute to a non-deductible IRA because even that is beneficial, because even that means that just the tax implication of the money actually in the account year after year, it's still growing in there faster, even though you don't get a current year deduction on your taxes or a future tax benefit. You still have your money growing faster. So it's still worth doing. Okay. But the phase out ranges for both traditional IRA contributions and Roth IRA contributions have increased from 2020. I'm not going to read a bunch of numbers here and bore you, but you can look them up. Just know that if you were ineligible last year, you might be eligible this year. Okay. That's for those of you who are kind of riding near that threshold of income. Okay. Next and last from the IRS, the income limit to get the saver's credit. If you don't know, the IRS has a pretty nice credit called the Savers Credit for low and moderate income workers who contribute to an IRA or to, who contribute to retirement accounts. So the income limit for the Savers Credit is now $73,000 for married couples filing jointly, and it is $54,750 for heads of household. Head of household means you have a dependent. You're single, but you have dependent or multiple. And $36,500 for singles and married individuals filing separately. I want you to know that the Savers Credit is a credit of $1,000 for an individual, and if you're married filing jointly, then it's $2,000. So it's $1,000 per individual. And remember, a credit is always more powerful than a deduction. If you didn't know, a credit is a dollar for dollar deduction off of your tax bill. So credits are powerful, much more powerful than a deduction. They're also more progressive than tax deductions. Tax deductions actually are a little regressive because basically the higher benefit goes to the taxpayer with the higher tax rate. And that is going to be a person with higher income, right? So there's more benefit for a higher income person and less benefit for a lower income person. That's true of all deductible expenses. Now you know. All right, but a credit benefits us all equally, and therefore, if you have lower amounts of income, it's, probably proportionally benefiting you more. So a credit is more progressive and less regressive. There's a little tax tip, tax education from from me. Okay, so what can you do with this information? All right. I want to just talk to you about getting in the habit of budgeting each month for your retirement. If I do nothing else in the work that I do in this world, I want to get more visionary, values-based, ethical people doing really good work in this world, whether you're a healer, artist, person serving underserved populations. I want you to save for your retirement. I want you to build a giant pile of FU money, okay? To me, a fairy gets her wings every time an artist maxes out her IRA. So make me happy, make that fairy get wings, fulfill my life goal, and please max out your IRA every single year if you can. And even better, open a solo 401k and max that out. The limit is much higher, and that is a lot more money in your pocket. So what does it take to max out your IRA? Well, an IRA, as we just discussed, the contribution limit for 2023, $6,500 now for Roth or traditional. That breaks down to $542 a month if you want to set yourself up with an automatic transfer from your business bank account into that IRA account, or into just a savings account, which then you put in a lump sum at the end of the year. That's possible. That further breaks down to $125 per week if you wanted to do it weekly. Okay, so that's to max out your IRA, takes $125 per week. It's something, it's effort, it's not nothing, but it's not impossible, right? A lot of you spend more than that on takeout, right? Okay, now what does it take to max out a solo 401k? That's much higher contribution limit to that. Also, I want to warn you, it's an earlier deadline. 401k deadlines are December 31st, unlike the IRA deadline, which is April 15th, okay? So for your solo 401k, if you have one, if you set one up, and yes, if you want to know how to do that, Money Bootcamp, of course, I teach you how to do that. But here's what you would need to set aside. To get $22,500 set aside for a year, you would need a monthly savings of $1,875. That breaks down to $433 a week. Now, the thing about a solo 401k, and the thing that unlocked it for me personally, was running payroll. So I am now taxed as an S Corp. That's been true for me for just a couple of years now. And one of the requirements of having an S Corp is that you have to run payroll. It's actually required. And you are, registering with your state for employment tax, paying workers' comp, all that stuff, right? I'm an official employer in the state of North Carolina. And you must be too in whatever state you are living in if you elect an S Corp to be taxed as an S Corp. Now, the thing about it is you do not need to have an S Corp and you do not need to run payroll in order to open a solo 401k. You don't need that. It's just that it makes it a lot easier. So for me, I use a payroll software that I adore. It's called Gusto. I love it, love it, love it. I'll put my affiliate link in the show notes in case you're interested. But I love Gusto so much because it basically takes this like very expensive accounting process of running payroll and makes it just a software fee of $39 per month, which is so much less than you would pay an accountant to manually run payroll for you. And believe me, I have friends ragefully texting me their accounting fees. And so I know how much people are getting charged by their accountants to run payroll manually. Even though the accountants probably aren't actually doing it manually. So I run Gusto. So because I'm running payroll, it actually makes it pretty simple to then plug in. And the company that I use for this is called Guideline. And so that plugs into my payroll software pretty easily. So through this company called Guideline, I was able to set up a solo 401k quite easily. And the cool part is because I have payroll running, I can pull a monthly withdrawal out of my salary to go towards my 401k. This means I don't have to think about saving or setting aside $1,800 every month. I have it completely automated, which means I never miss it in my bank account, right? It never goes into my spending account at all, right? It's going straight into my 401k. I'm not touching it until hopefully like 30 years from now. So that is really, to me, one of the keys to being able to max out a solo 401k, but it's not a requirement. And I have set up solo 401k plans for clients of mine who do not have payroll. So don't think that it's an absolute requirement. I will tell you that one of the accounts I did not mention here today is called the SEP IRA. And a SEP IRA is a really good option for a person who does not have payroll, because the SEP IRA contribution limit, and this is unchanged because it's a percentage of your profit, but the SEP IRA limit is 20% of your profit in your business for the year is what you can put in tax deferred to your SEP IRA. So the limit to that has not increased because it's based on your profit, right? So the IRS is not going to put out a memo saying they increased it unless they were to actually radically change the SEP IRA structure itself and give you a higher percentage. That's not the case. So in case you're listening to me talk about solo 401ks and you're like, but I'm a Schedule C, I don't run payroll, I don't have that, I will say the SEP IRA probably, it might be a really good choice for you to consider to put those higher dollar amounts aside for yourself for your retirement. All right. Okay. So that is my passion project. Definitely send me a message on Instagram. I'm really curious to know like how much it lands with you when I talk about retirement, when I talk about FU money. It's something I just really want more people to understand, that it can be accessible to you and that it is possible. And not only that, but it gives you a lot of power. But I just have this feeling, this sense that it's not landing and that a lot of people are writing off the possibility altogether without actually seeing the math behind the fact that these tax advantage accounts make your money really grow. And that when you have your money invested and benefiting from compound interest, that it's actually really going to grow substantially and you might be able to be in much better shape than you think. But the metric that helps you the most is time. And so the younger you are, the longer the timeline you have, the smarter you are to put money in early, because when you start a little earlier, it requires so much less money over the course of your lifetime. All right. So financial security is possible, but the earlier you get started with these accounts and this system and this habit, the better off you will be and the less money it will take to get there. All right. So I just want to point you I just want to say that in my free masterclass, you can watch a recorded version of it. I do take a fair amount of time in that class to actually show you a graph of what the growth curve looks like of a $6,500 IRA contribution year after year on a 40-year time horizon. And I actually go through and show you what the math of that and what the growth looks like. It's impressive. You'll be a little surprised at how much money it turns out to be at the end. So if you're interested in just seeing me walk you through that math, you can watch this masterclass. It comes maybe at like the halfway point. So you can get that class on demand at go.sunlighttax.com/register. No pressure, but I just want to let you know that I do that math every time I give a free class because it is my passion, even if it is not maybe the smartest thing for me to be talking about from a, I don't know, marketing standpoint. Anyway, make me happy, make an angel get her wings, give yourself the power to do more of that amazing work you do in the world by having fuck you money in the bank. That's what I want in the world. That's my personal mission. So thank you for listening to this episode where I let her rip on my my passion project, getting ethical people to save for retirement. All right. I hope you enjoyed this. Send me a DM on Instagram. Let me know if this topic resonates with you, kind of what your feelings are about it. And be nice. Don't make me cry at the dinner table. Thanks. All right. Thanks for listening, everybody. I will see you on the next one. Bye. Thank you for watching. If you like this video, be sure to like, leave a comment, and subscribe to my channel. I'm so grateful for that. This video is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.